Natural gas, bad to worse. Prices flirt with multi-year lows as the coronavirus adds to an oversupplied market, putting pain on producers. Forget chocolate for Valentine's. Cocoa prices buck the trend and rally on weather and production fears. And reimagining BP. I sit down with new BP CEO Bernard Looney about the future of the company. Welcome to Bloomberg Commodities Edge from London. It's 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we kick it off with Spot On. It's our take on the big story, and the spotlight is on oil. You have crude flirting with a bear market as the coronavirus eats into demand. The IEA, the latest, with crude slipping on virus fears, saying the global oil demand is going to drop this quarter for the first time in over a decade before rebounding in the third quarter. Joining me now is Jeff CURRIE, Goldman Sachs Global Head of Commodities Research. My long-running joke with the IEA is that they're going to revise it down and down and down and down again when it comes to demand. I mean, are they right? Is it going to be steeper or not as bad as they think?
The current environment is pretty dire, what's going on in China. I mean, you saw the Baltic Freight Index went negative, which is an indication just how weak the demand picture is. Now, oil's a little bit different from some of the other commodities. Let's take steel. I'm pretty comfortable saying demand is down 50, 60% year over year. We have data. Oil, we know there's nobody out there driving. We know what the activity is. We know it's down, but where are you storing the oil? We don't see it backing up. Let's take natural gas. We know LNG imports are down 40%, but you don't see that in oil. So we know the oil's going into China. We know the demand's off, but you can't store products infinitely.
So is the reason why because it's not cheap enough to then justify floating storage, and there's still room in tank tops on shore?
But if it were floating storage, we would see it. We would see it in freight rates. Freight rates are low. They're about like what they were during the Chinese New Year last year. So they're low, but they're not catastrophically low like the Baltic Freight Index. But they're not high enough that they're contracting ships for putting in storage. So, I mean, if you do the math and you go, okay, where are inventories? It would suggest demand for oil is down, let's say, 3 or 4 million barrels per day. If it was down as much as metals and all the other markets, you would be down 6 or 7 million barrels per day. But you got to ask, where's the oil? So I do agree with their right. But there is something very mysterious about oil that sits very differently. Because like natural gas, it's been absolutely clobbered.
Yes.
You've got JKM now trading at a discount to Europe, not to the U.S. yet. But why? Because we saw that, if you look at one way to think about natural gas, China is the most short natural gas of all the different commodities. So when you see the drop in demand, it's got to hit the imports immediately. It did what you'd expect. Prices got crushed, and we're comfortable with the weakness in demand there. Aluminum's on the flip side. They're long aluminum. Aluminum's barely budged because you're going to lose the supply they typically produce. Again, consistent with everything we know. Oil, on the other hand, they're short. It's just not backing up the way you'd expect.
So if you look at the contango in the 1 to 12 month for Brent, what does it tell you? What is it reflecting, and what should it be?
See, that's the thing is you've gone from a backwardation to a slight contango. You're not full carry. You're running 25, 30 cents on the front month. If demand was really down, let's say 6, 7 million barrels per day, which would be consistent with steel and some of the other commodities, the front end of that curve should be backing up substantially. Maybe it's going to happen in another week and we don't see it coming, or maybe the demand is not as bad as we think.
Or is it supply?
That's something, but can they cut? They produce roughly, let's say, 4 million barrels per day of crude. They import 10. You really can't shut that production down like you can with coal. We know coal is down. That's another one where we know production there is down around 40%, consistent with the loss in demand. Again, we got data there. But I don't think that's the answer either.
So do you think that OPEC is secretly cutting? And by OPEC, I mean Saudi Arabia? Like, how do you account for this?
Again, let's go with what, we don't see it in the loading data. You don't see it in the shipping data. You go by what, the word of mouth out there is that a lot of the exporters into China have cut by around 10%. But that's not enough to explain the magnitude of the drop. So bottom line here, I agree with the IEA. And the IEA was very careful today. We don't know either. It's the one commodity. The other commodities, I'll give you a number. They didn't say it either. It's going to be down in first quarter, and I'm comfortable with that. How big is it going to be down? We don't know.
So do you buy time spreads here? Like, what's the trade then off of that?
On the back end of the curve, you could argue that they were mispriced, and they have improved somewhat. But if it's very binary. Either this is a lot bigger than we think, and you got a lot more downside in the coming weeks, which we would argue that what's being mispriced would be puts. We would be buying puts out on the back end. But the other offset to this, and we see it in the metals market, is the stimulus that is potentially coming down the pipeline. You already see it in special purpose issuance by local governments in China, so that they've already ramped it up to levels higher than what we've seen last year. So they're teeing this up. And I think that's what the equity markets are pricing. The equity markets are looking at, hey, big stimulus coming down. In fact, everybody saying this is whatever it takes, part two, in the sense that she is going to throw everything at it to prevent something bad happening.
So in that respect, do we need an OPEC cut? Because the Persian Gulf guys are one of the biggest sellers to China. They could stand to lose a lot of money. Do they need to cut then? Yeah,
that's. I think if they had a clear read on this, you'd see them already do it. Because there's another offset of this is that China's a big producer of product. And if either they should have crushed the product margins and exported all this product out, that's not happening, or they didn't produce it and product margins are widening, that's not happening either. So it's very mixed signals of what's going on. It's kind of a black box. The oil comes in there, we know the demand's off, but we don't know where it's really going. Maybe they're just out driving and people are joy driving or something like that.
And we just don't see it.
We just don't see it.
Oh,
but you don't even see that in the TomTom data. The TomTom data suggests that the traffic's relatively weak. So oil is the one mysterious commodity out of all the commodities here. And I think the fact that OPEC hasn't acted, they too are looking at the conflicting signals. IEA came out this morning. It's down, but we don't know how much it's down.
Yeah, never what you want to hear from like an official agency. All right, Jeff Currie of Goldman Sachs will be sticking with me. Coming up, BP's new boss faces some climate challenges. The company is forced to close down its London office, its new office, amid Greenpeace protests. That was just days before it unveils a new 30-year strategy. I'm going to speak to the company's CEO, Bernard Looney, on his emission plans in an exclusive interview. This is Bloomberg. I'm Alix Steele, and this is Bloomberg Commodities Edge. Time now for the data dig, where we delve deep into some of the market trends. First up, you got crude oil inventories. They rose 7.46 million barrels, much larger than expected, particularly in Pad 3. If you can't export, you're going to have stockpiles moving higher, and that's going to keep pressure on WTI. Also, the oil industry leaders did warn President Trump and the administration the trade war with China was actually unrealistic, and the U.S. is actually going to struggle to produce all the oil, gas, and other energy products that China actually committed to buy. So according to the American Petroleum Institute, China would have to import about 1 million barrels per oil a day, 500,000 barrels per day of refined products, which they already make a lot of, and 100 tankers full of LNG. That's a pretty heavy haul. And wrapping it up, cocoa's feeling the love, but for you on Valentine's Day, it actually might be expensive. Cocoa futures now have surged about 15% so far for the entire year. You got lack of rain in key production areas of West Africa, the world's top supplier, lifting prices. All right, now let's get into the ring. It's the virus versus gold. Investors continue to weigh the economic impact of the spreading outbreak and its impact on safe haven commodities. Mark HAEFELE of UBS Wealth Management told Bloomberg he thinks gold could finish the year strong.
One thing that our clients are looking at, however, is gold, and we think that gold could finish the year at $1,600. It's not necessarily something that we want to add to our long-term asset allocation, but I think that clients recognize that should things go completely wrong and inflation start to pick up again, it may be an asset that gives them that measure of insurance.
Jeff Currie of Goldman Sachs still with me as well. 1,600, we go higher. What's your call?
I think the risks are to the upside around that target. Our target's the same thing, but on a 3-month horizon. There's 3 key reasons to why we're bullish on gold. The first foremost is geopolitical risk hedge, and we saw Iran more recently, and the events around the coronavirus. A lot of reasons. By the way, the reason why we don't see any response out of the coronavirus. Remember, China is the largest jewelry buyer in the world, and if they're not going out and buying, you get the weakness. And so you look at gold has been trading 1570 and change now throughout this because you just don't have the bid coming from the physical side. So we assume they come back and buy. So geopolitical risk. The other one is the de-dollarization, and that's one of the ones that we really view as a substantial reason to own gold. you have central banks around the world right now diversifying away from dollars. Last year, they bought 750 tons of gold, represented 22% of global gold supplies, and is the highest level since the Nixon era. So that is, I think, a big key issue, will continue to be a driver going forward. The third reason has to do with a savings surplus. You look in, economic theory says savings equals investment. Well, what are we seeing across the commodity space in the old economy? CapEx is down everywhere. In fact, before the coronavirus, we had that problem, and it's likely to be a problem afterwards. That opens up that gap and creates excess savings. And that excess savings, a lot of that's being put into assets like gold, which is helping to support gold. And that what follows along the lines of the negative real rates that you have in places like Europe.
And more stimulus, et cetera, et cetera. All right, another commodity we want to dig into is natural gas. So LNG is having a very rough start to the year, and the virus fears are making it a lot worse. Global natural gas prices are drifting lower, making U.S. LNG even less competitive abroad. Well, joining us now is our Nat Gas and Power Markets reporter, Noreen Malik. It's unbelievable to see the convergence of all these global natural gas prices. What was the really big catalyst here?
Well, the really big catalyst is that the entire northern hemisphere has seen an unusually mild winter. Everyone knew that it was going to be bad, potentially bad this year. We've had an unprecedented growth of U.S. or global LNG export capacity led by the U.S. and Australia in the previous 2 years. So people saw this glut coming, but really there was hope that winter would show up and soak up a lot of this excess supply. Well, that hasn't happened. The U.S. and Europe and Asia are on track to have some of their warmest, if not warmest, winters on record. That's allowing inventories to build up globally. And now you have this booming global LNG trade. And so the threat that everyone is looking at is how quickly or how much could we see a slowdown in that?
And a lot of this is also now with force majeure, where you have China saying we're not going to take delivery of this LNG that we promised to buy because we just don't have the demand, and that counts. And Total obviously suing China in response. What does that mean? How does that work?
Yeah, usually you see force majeures like in the U.S. when there's like a pipeline outage, like maintenance problem. So this is kind of a new thing on the global market. And you saw European energy companies say, hold up, a virus, yes, like an illness is like a huge issue, but it doesn't quite meet the standard of a force majeure. So that's something that is being worked out. And POTEN and Partners said today that Total, which CNOOC was going to declare a force majeure on a February 7th cargo, they managed to work that out in exchange for deferring cargoes. And we're hearing about Qatar deferring some cargoes. And so that's kind of like an early indication of like, how can that spread? Like, are you going to see more of those? And then eventually the bigger threat is, are you going to see outright curtailments, especially, everyone's really focused on the U.S. where we just have excess supply, and Permian gas is already trading at negative levels for March.
Noreen Malik of Bloomberg, thank you very much. Good perspective. So, Jeff, when you take a look at the natural gas market, what happens? Because Europe was basically the sinkhole for U.S. LNG. Now what?
It's still the sinkhole. When you look at pricing, one thing that happened in the last couple of days that we've never seen before, JKM now trades at a discount to TTF here in Europe. So if you look at where the ARB's still open. You're trading $2.75 here in Europe. You're trading $1.80 in the U.S. right now. ARB's still open. Where is this going to go? It's going to keep coming into Europe. And so really the question, in fact, I heard yesterday there's so much gas here that they're actually injecting gas in the middle of the winter. Combine that with the warm weather. So I think the key issue, that we're focused on looking further out towards the spring and the summer, is are you going to see the Europeans flinch? Will the Norwegians cut? They have a 40% market share. So for them, they're like a very large, oligopolistic player. And I would tend to think that Gazprom will keep pushing against, because if you are a European player, you got the U.S. LNG coming into your backyard. If there's ever a time to push it out, now's the time. And you're getting to the levels of shut-in prices in the U.S. where we're trading, let's say, $1.80 right now. You got to go down to $1.10, up in the Appalachians. That, depending on what the net back is, you're talking somewhere between $1.60 and $1.80. We're in that range, but we think you probably need to go a little bit lower before you start to get to those kind of levels.
Feels very much like the Saudi Arabia of natural gas in terms of Russia. All right, Jeff, really great to catch up with you.
Great.
Thank you so much. Jeff Currie of Goldman Sachs. So coming up, the new BP boss sets out his ambitious vision. It's my exclusive interview with Bernard Looney, CEO of BP, coming up next. This is Bloomberg. I'm Alix Steele. This is Bloomberg Commodities Edge. We turn now to Commodity in Chief. We focus on one executive in the commodity world, and today it's Bernard Looney, BP's CEO. I spoke with him exclusively at the company's Investor Day.
We have, as I said, a long history in Russia, 30-year history in Russia, and that relationship is deep, and there is a lot of trust between BP and Russia, and indeed BP and Rosneft. And what I have found is like any relationship where one party treats the other with respect. I think there is real dialogue and there is real listening, and I have every confidence that if we have something that we can add to improve their business, they listen, just like I should add, when they have ideas to help our company, that we too listen to them. So it is a two-way street.
The other part that many wonder if it melds with your agenda is U.S. shale and flaring in particular.
Yep.
And flaring, Rystad just had a report that showed that if you count actual production as well as the processing facilities, flaring is much, much worse than anyone ever anticipated in the U.S. How do you square that?
Yeah, and I think I just have to acknowledge the fact that I think there are some reports out there that says that our percentage of flaring in the Permian is at the very high end compared to our peers. Now, the volumes aren't large, but on a relative basis, it is large. That is because we have taken over an old set of operations. We are clearly building the new operations there in a very different way, which will have a very different greenhouse gas intensity profile. So that is one. But two, I'm not satisfied with that, and I have asked Dave Lawler, who runs that business, to really look, and he is coming back in a few weeks, to how we can accelerate what we are doing there, because it is very important that people see action, not just words, and that is one of the situations that we have to address.
And you mentioned, the assets that you bought are older. So what do you do with them? How quickly can you change them?
Well, the good news is that we're absolutely delighted with the assets that we have bought in terms of what we have managed to secure. The rocks are better than what we thought. And the synergy targets that we have, we said we would deliver $350 million a year by 2021. We've actually increased that synergy target to $450 million per annum. So the business is running very well. We're very confident in the assets that we have bought, and we are now working to make sure that the environmental performance is on par with some of the ambitions that we laid out earlier today.
Are you going to have to, though, lay off staff?
I think it's inevitable. We have a very large company. We operate in about 78 countries around the world. I think it would be insincere not to suggest that there will be some staff layoffs as part of this program. That's not the objective. That's not what we're setting out to do. But over time, this is not something that's an overnight thing, but over the next several years, that's very possible.
I just ask because it feels like there's a divide between how Europe is handling the energy transition versus how U.S. companies are doing it, particularly in Houston, particularly in the Permian. So it feels like that's the area that needs to go, and I'm wondering how your employees are reacting to that, how they feel about this transition. Have you already started to have to lay off workers in Houston?
So I should be very, very clear. When I was talking about layoffs, that is about the restructuring that we announced today and the reorganization. The energy transition does not result necessarily in layoffs at all. That is not necessarily a consequence of that. There are huge opportunities for people inside our company. Businesses will grow, no doubt, within our company. The Permian will grow. The Gulf of Mexico will grow. So there are great opportunities for our people in Houston. The question of any redundancies is about the broader restructuring of the company, which is a multi-year journey. The energy transition creates as much opportunity as it does for people as anything else.
So I feel like if you were sort of a US E&P, it'd be like, who do you want to hire? You want to hire engineers, probably like a techie to help you with all the digital transition, et cetera, maybe some truck drivers. Like that's who you want to hire. Who do you actually, though, want to hire if the company that you see it becomes a reality?
Well, I think the reality is, and I think Dave Lawler, who runs the Lower 48 BPX business, he situated himself in Denver for a reason. Denver is a sort of a tech capital, or becoming one, and he believes that the work of the onshore United States business is a tech business, is a digital business. For BP as a whole, I think we want people who are values-based, things like respect, inclusion, openness, willing to learn. These are values that I think are hugely important. And clearly, Alix, we want to hire people who are digitally savvy, And quite frankly, that's not a problem today. We are looking at hiring people from Uber. This is a very attractive industry. People want to work and make a difference in the world. And if you want to make a difference in the world, particularly building off of what we announced earlier, what better company or industry to come and work in?
That was my interview with Bernard Looney, BP CEO. Time now for BNEF Brief. Now, Bloomberg NEF released the 2020 Sustainable Energy in America Fact Book that provides a look at the state of U.S. energy and the role new technologies play in reshaping the industry. Joining me now from Washington is Steph Monroe from Bloomberg NEF. Steph, it had a big year for renewables in 2019. What was behind it?
Well, the dominant theme we saw was parity in prices on the part of nuclear generation. It's the case almost everywhere in the U.S. now. You can build a renewable power plant for the equal to or less than any other form of technology, and that's why we had the turnaround and the big growth in new power plant build by renewables in 2019 after a 2-year contraction.
So how much of that, though, is strong demand from the economy doing better versus demand for really that kind of clean energy?
Well, it's a little ironic because the economy is continuing to expand. It grew by more than 2% in the U.S. last year, but energy demand fell slightly. This is the result of energy efficiency measures across the board.
So where do we see this parity? Where do we see it most in the market?
Well, a good place to look would be in bilateral purchase contracts by large corporations. These are corporations that are going directly to wind and solar plants, buying power from them because the power is available for a lower cost than through its local utility. We're seeing this practice being carried out by big tech companies, by insurance companies, even by public agencies like the state of Virginia.
It was a good report. Thank you very much, Steph Monroe of Bloomberg NEF. Lots more to unpack with that. All right, here's what's on my commodity radar for next week. So Monday, you get earnings from Glencore as well as BHP. You definitely don't want to miss those numbers. Then Thursday, you get a Shell's LNG outlook, always a huge player in that market. And Friday, we get earnings from Deere. It's the state of the U.S. farmer that's front and center. That wraps it up for Bloomberg Commodities Edge. Special edition from London. Make sure to catch us each Thursday at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg.